Hey guys, welcome back. So in this video we are going to discuss about the supply and demand zones, and we are going to discuss that in detail and learn how you can detect supply and demand zones in your forex charts. So in forex or even in stocks, there are basically two states of the price movement. The movement can either be balanced or unbalanced. So let me show you by example what I mean. So in a balanced movement, what happens is the price moves sideways. As you can see here, the price goes up, then goes down, and then goes up, then goes down. But in an unbalanced state, what happens is either the price moves, tanks a lot, and goes down and keeps going down, or the price starts moving up and keeps moving up. So the candles, most of the candles that you will see in unbalanced state will either be bearish dominant or bullish dominant. So here it's like bullish dominant, and here it's bearish dominant. So like there are two states. The first one is balanced state and the other one is unbalanced state, where there's a lot of movement of price. The price movement can either be upward or downward. So let me try to explain about how zones are created. So in any zone that you see here or here, there will always be two big candles and one or more than one base candles in the middle. So here these are two big candles, and right there is one base candle. So this supply zone is a rally base drop. So what is happening here is the market is bullish, okay, and then the market is stable or balanced in the middle, and then the market drops, the price drops. So here you can see the bullish trend, then like it goes sideways, and then there's bearish trend. So what happened here was that there was enough supply that it let the sellers take control of the market, because like when the price is moving up and candle is bullish, the buyers are in control. But when the price is moving down and the people are selling, the sellers are in control. So here a supply zone is created because there is one bullish candle, then there is base candle, and then there is one bearish candle. So here this zone which is created between these two candles is basically a supply zone. So there are some technical requirements as well for any zone, and those technical requirements are that the body to wick ratio of the big candles should be more than 70%, and the body to wick ratio of the base candle should be less than 50%. So this supply zone, which you can see this pattern here, is rally, like the price goes up, then base, in which the price moves sideways, and drop. So this is basically rally, base, drop, supply zone. Okay, now let me show you another supply zone in which there is drop, base, and drop. So what is happening here is that market is going bearish, okay, there's big candle, and then there is one base candle, okay, and then again the market went bearish. So there was enough supply and people were selling and sellers were in control. So this zone is also a supply zone because there is one big candle, okay, then there's base candle, and then there's again one big candle, that like this base candle is sandwiched between two big candles. So this is basically a supply zone as well, and this supply zone is drop, base, drop. Okay, now let me explain you about the demand zone and how demand zones are created. So here when we see that the market went bearish or market went down, and then there was the movement of price sideways like the base candle, and then again here there is a one big candle. Okay, so here the sellers were in control and there was more demand than supply, and again the buyers took control of the market and started moving the price upward. So these are two big candles and there is one base candle. So this is also a demand zone, and this demand zone is basically drop because the price dropped here, and then there's base region, and then there's rally region where the price moved upward. there's another type of demand zone. So let me explain that to you. So here you can see that this demand zone, in this the price moved upward, or the market was bullish, okay, and then there was sideways movement, and then again the market remained bullish. So these are two big candles, and there's one base candle in the middle. So this is also a demand zone, because like the supply was not enough, that and buyers were in control, so they kept pushing the market upward. So this is basically a demand zone created here, and you can tell that this is a zone or demand zone because like two big candles are sandwiching one base candle, and this zone is rally, base and rally, because price was moving up, then and it was moving sideways, and then it kept moving up. So this is basically rally, base, rally. So there's another thing that you need to consider when you are spotting these zones and you're going to trade based on these zones, is that the strength of a supply or demand zone. So there's a technical way through which you can see either a zone is strong or weak, okay. So the strength of a zone depends upon how many number of base candles are there in between two big candles. If the number of base candles are large, the zone is basically weak, and if the number of candles are less, the number of base candles between two big candles are less, then the zone is the strongest one. So here you can see there's only one candle in between two big candles, and this is basically a very strong demand zone, okay. And here there are two base candles in between two big candles, so you see this is also a demand zone, but this is weaker than this strongest demand zone. So this is you can say this is a stronger zone, okay. And here there are three base candles and two big candles which are sandwiching these three base candles. So this is also a demand zone, but this is not very strong demand zone, okay. This is good, this is not the strongest one. So you can tell about a zone is strong or not by looking at number of base candles in between the two big candles, and keep that in mind that this is inversely proportional. The more the number of base candles in between two big candles, the less strong is the zone. So let us understand this through the example on our charts, okay. So let me take you to the chart here, and let me zoom in so that you can see clearly. So here you can see that a supply zone is created, and you can tell that this is a supply zone because there's a bearish candle, and then there's again one big bearish candle, and these two bearish candles are sandwiching one small or base candle. It doesn't matter that the base candle is either bullish or bearish, but it needs to be that like the body to wick ratio is less than 50%, and then there are two big candles which are sandwiching this base candle. So this is basically a supply zone, and this is a very strong supply zone for our 2-hour time frame which we are working on, okay. And if there were more base candles in between these two candles, these two big candles, so this zone would have been weakened. And let me show you another example, okay. So here you can see that there is a demand zone created, and there is one big candle, this one, okay, and another big candle, this one, and then there are some base candles, okay. So these base candles, as you can see, there are a lot of base candles here, and this zone is basically a demand zone, but a weak demand zone. This is not as strong as this supply zone because there are a number of candles in between two big candles. If we look into this zone and we go into smaller time frames, we can spot the big demand zones here in smaller time frames. So if you go and look into it for like 1 minute time frame, there are small zones created here as well which are demand zones, and they are strong demand zones. But when we look at it from this perspective and look at it from 2 hours time frame, this is basically a weak demand zone. Okay, let me go here to show you another example. So here you can see there's again a supply zone created here and here, because there is a big candle, this one. Okay, let me zoom in a little bit. So here there's a big candle, then here there's another big candle, and these two big candles are sandwiching these three base candles. Okay, so there's a supply zone created, and here again there's one big candle, and again there's another big candle, and these two big candles are sandwiching these small candles. So this is another supply zone. You can also visit our website www.forexb.co to learn more about price action and forex and get yourself ready to trade. Hey guys, welcome back to another video, and today in this video we're going to talk about strong supply and demand zones. Okay, we're going to see how you can draw supply and demand zones and how you can differentiate between a strong supply and demand zone and a weak supply and demand zone. Okay, because the supply and demand zones are forming throughout the day in your chart. So you need to look for the zones which are strong, and you need to add some filters or add some confluence so that the probability of your trade making some profit becomes higher. So that's why you need to always look for a strong supply and demand zones and then place your trades. And this is what we're going to discuss in this video. Please make sure to subscribe to our channel so that you will be the first one to know whenever we upload any new content. So let's get on with the video. So in order to identify the strong supply and demand zones, there are basically 3 steps that we need to follow. Okay, the first step is identifying the supply and demand zones. The second step is adding a confluence or a filter or Fibonacci retracement. Okay, we need to draw the Fibonacci retracement, and then the third step is basically we need to draw the strong supply or demand zone. Okay, so let's go ahead and discuss about the first step, that is identifying the supply and demand zone. Now there are basically, as we discussed in our previous video, that there are basically 4 types of supply and demand zones. Those can be the rally based rally demand zone, okay, rally based drop supply zone, the drop based rally demand zone, and the drop based drop supply zone. So if you haven't watched that video, please go ahead and check that video out so that you can understand how you can identify supply and demand zone. Okay, we have explained in detail how you can spot any of these 4 supply and demand zone and how you can see if there is a valid zone in your chart. Okay, now let's go ahead towards the second step, that is basically drawing the Fibonacci retracement. So here what we're doing is we are adding a confluence or a filter to our zone in order to identify if our supply or demand zone is strong or not. And we are doing this by drawing the Fibonacci retracement by using the Fibonacci retracement tool. And what we need to do is we need to look for the zone, if the zone is available within our golden zone. Okay, golden zone of Fibonacci retracement basically. So the golden zone of Fibonacci retracement is between 50 and 61.8%. So if our zone that we spotted in first step is within this golden zone, that 50 to 61.8 Fibonacci percentage, then that means that this zone is basically a very strong supply or demand zone. And the third step is basically drawing the zone. Okay, drawing the zone or adjusting the zone if it's a little bit out of this golden zone, okay, or this 50 to 61.8 percentage level. So these are the 3 steps that we need to follow in order to determine if the supply or demand zone is strong or not. Okay, so now let's go through an example in order to see how you can apply all these 3 steps in order to determine the strong supply and demand zone. And in the end, we're going to go through some of the examples on the charts in order to validate what we have discussed. So here, if we go here and let me just zoom in. So the first step is basically determining the supply or demand zone. So once we have found out that there is a demand zone, what we need to do is we need to draw that zone. So let me just go ahead and draw that zone here. And you can see that this is basically our base. And let me just adjust this, and we want to background to be, let's say, green. Okay, so you can see here that this is basically a demand zone, and this is a rally based rally demand zone. So we have outlined that zone, and the next step in our analysis is to add the Fibonacci retracement in order to see if this zone is strong or not. Okay, so let me just go ahead and get the retracement tool, the Fibonacci retracement tool, and let me draw the Fibonacci retracement. So once I draw this, we can see that this zone is in between our 0.5 and 0.618, or basically 50% and 61.8%. so this is a strong demand zone, and what this allows is it allows us to take the pinpoint entry, and it also increases the probability of our trade going in the right direction. Because now one thing we have done is we have detected a supply and demand zone, and then we have added a filter or a confluence of Fibonacci retracement in order to detect if the zone is strong or not. So both these methods combined are a very powerful tool in order to determine if the zone is strong or not. Okay, so now let's go ahead on the charts and see if we can find out some strong supply and demand zones. All right, so let's go to the charts here, and let me just look for any supply and demand zone. And okay, let me just zoom in, and here this zone, you can see that this is basically our rally demand zone, similar to what we saw above. Okay, so now what I have done is I have completed the first step, that is I have detected the zone, or I have seen the zone. Now I need to validate if this zone is basically strong or not. So in order to do that, what I need to do is I need to take the Fibonacci retracement tool, and we need to start from the bottom of the swing. Okay, so I'm gonna start from here, and I'm gonna take this to this high of our swing. And again, you can see that this zone is falling between our 0.5 and 0.618% ratio or percentage. Okay, that is between our golden zone. So this zone, or this demand zone, is a strong demand zone. This validates our analysis. Okay, and you can also see that the price retracement back here, and what it allows is it allows us to take the pinpoint entry, and the price went back from there. Okay, so now let me go ahead and look if we can find any other supply and demand zone, and let me just zoom this in. And you can also see here that these are basically our supply and demand zones forming here, and this is basically a demand zone forming here. And let me just go ahead and draw that out so that you can see. So here you can see that this is also a demand zone forming here. Now again, what I need to do is I need to check or validate if this is a strong or a weak demand zone. Okay, so what I'm gonna do is I'm gonna take our Fibonacci retracement tool, and again this is basically a complete swing from here till here. So what we need to do is we need to draw the Fibonacci retracement from the bottom of our swing and take it to the high. Okay, so again you can see that the area of this zone or this demand zone is in between our golden zone or golden percentage of 50 and 61.8. so now what we need to do is we need to adjust our zone in order to take the pinpoint entry. And here you can see that we have spotted a strong demand zone. Okay, now let's go ahead and see if we can find any other example of our demand zone. So let me just go down to the bottom and see. Let me just zoom out so that we can see more candles. Okay, this one here, again you can see that there is a rally demand zone. So let me just zoom this in, and let me just draw that zone so that you can see. So this is our rally zone. Okay, And what we need to do is, again, we need to confirm if this zone is a strong demand zone or a weak demand zone. So what I'm gonna do is I'm gonna take our Fibonacci retracement tool again, and I'm gonna start from the bottom or low of our swing, and I'm gonna take it to the top. A major part of this zone is in between our golden ratio, okay, or in our golden zone. So we need to adjust this zone in order to take the pinpoint entry. So I'm gonna take this to this level, okay, and this level, and from here we can see that by using the Fibonacci retracement we are able to detect the strong demand zone. So this is how you can use the Fibonacci retracement and the supply and demand zones combined in order to detect the strong supply and demand zones. So let me just repeat what we have discussed in this video. The first step is basically determining the supply and demand zone. Okay, we need to determine if there is a supply and demand zone, a valid supply and demand zone, right? That is our first step. That zone can be any of these four types. Okay, the second step is basically looking for the supply and demand zone in between to be 50 to 61.8 percentage, and if that zone is in between that percentage, that means that our supply and demand zone is basically good or strong. Okay, and the third step is basically drawing the zone and adjusting it to our golden zone ratio so that we can take the pinpoint entry. Hey guys, welcome back. So today in this video I'm gonna show you how you can identify and detect strong supply and demand zones. We have already made a video on supply and demand zones in which we have discussed in detail about different types of supply and demand zones and how you can detect them. But today we're gonna add a confluence and we're gonna see how you can identify strong supply and demand zones. So without any further ado, let's get started. So here we have a demand zone. That is basically a base rally demand zone. Okay, and we can see that this demand zone is forming here, in which price is going up, then there is a range, and then after that price is going up again. So this is basically a base rally demand zone. So now how we can say if it's a strong demand zone or a weak demand zone? In order to detect or in order to identify if this demand zone or weak or strong, we need to see if the price comes back to this demand zone. Okay, and how much time does the price take to come back to this demand zone? Because after the formation of this demand zone, the institutions will put their pending orders. Okay, they will place their pending orders at this zone. So the earlier the price comes back to pick those pending orders, the more strong that demand zone is. And here we can see that this is basically a strong demand zone, because we can see just after the formation of base rally demand zone, the price came back and here picked the pending orders placed by the institutional traders, and then it went up. Okay, it continued in the direction. So this is basically how a strong demand zone looks. Okay, and now let me show you what a weak demand zone is. So here we can see that this is a similar type of demand zone forming here, and this is also a base rally demand zone. So in the strong demand zone, the price comes back to the demand zone right after the formation. Okay, as soon as the demand zone is formed, the price comes back to it in order to pick the pending orders, and that zone is basically a strong demand zone. But in weak demand zone, what happens is price comes back to the demand zone after a long time. Okay, after a while, it doesn't come back to demand zone right after its formation. So here we can see that the formation of demand zone, that is basically a base rally demand zone, and then what happened is price kept moving above the zone. Okay, it didn't come back, and it did came back, but it did that after a long time. Okay, we can see that the price kept moving here above the zone, and then after a while it came back. And this is basically a weak demand zone. So in strong zone, the price came back to the demand zone right after the formation of the zone. Okay, here we can see that it came back right after the formation. But in weak demand zone, the price came back to the zone after a long time, after moving for a while above the zone. So this is the main differentiation between the strong demand zone and the weak demand zone. So now let's see how you can differentiate the strong supply zone from a weak supply zone. Okay, and here we can see that this is supply zone forming, which is basically a drop supply zone, and similar manner, just as we saw in the demand zone, the similar is the case with the supply zones. Okay, after the formation of the supply zone, the price, if the price comes back to the supply zone as early as possible, then it is a strong supply zone. Okay, and if price takes some time and keeps moving below the zone and then goes back to that supply zone after a while, then it's a weak supply zone. Okay, and we can see that here this is an illustration of a strong supply zone where the price went up in order to pick the pending orders placed by the institutions right after the formation of zone. So this is a strong supply zone, and here we can see that the price continued moving below the zone for a while and then went back. Okay, and after that it picked the pending orders and then it continued in direction of trend. And now let me explain what is the logic between the strong and weak zones. Okay, so the logic is that if the price is coming back to that zone right after its formation, that means that the zone is strong because the orders are getting fulfilled right after its formation. The institutional orders are getting fulfilled. So in a demand zone, price goes back and picks the pending orders. Okay, and in a supply zone, in a strong supply zone, the price goes up after its formation and then picks the pending orders by institutions and then continues in the direction of trend. But in a weak zone, the right after its formation, the price continues to move above the zone. Okay, it does not come back. And in case of weak zones, what traders are going to do is they're not going to keep their pending orders in place for a long time. Okay, if they're not fulfilled, they're going to delete those pending orders. So when the price comes back to the zone after a while or after a long time, it has become very weak. Okay, and that's the logic behind how we can differentiate between strong and weak zones. So now let me go through examples so that you can understand it completely. So here we can see the formation of a demand zone, which is basically a base rally demand zone. Okay, and we can see that this is a big candle, which is basically a rally candle, and then these are the base candles, and after it there is a formation of another rally candle. So this is a demand zone, and we can see that the price came back right after it. The next candle is going downwards. Okay, in order to pick the pending orders that were placed by the institutions, and as soon as it fulfills those orders, it continues to move in the direction of bullish trend. So this is a strong demand zone. Okay, so now let me show you an example of a weak demand zone. Okay, and here let me zoom in, and here we can see that the similar type of demand zone, that is basically a base rally demand zone, and we can see the price did not come back to the zone to pick the pending orders. It continued to move in the direction of trend above the zone, and it did come back after a while. So when it did not come back to the zone for a long time, the zone became weaker and weaker, and we can see that when it did come back to the zone, the price just went below. Okay, it started moving in the bearish direction. So let me show you another example of a weak demand zone. Okay, so here we can see the formation of base rally demand zone, and here too we can see that the price did not come back to the zone right after its formation. It took a while. Okay, and when it did come back, we can see that it took a long time because the price continued moving above the zone. So this is a weak demand zone. So let me just repeat what we have discussed in this video, and let me just go here. So we have discussed how you can identify strong and weak demand zones. Okay, how you can differentiate between strong and weak zones, and we saw that if the price comes back to a zone right after its formation, then it is a strong zone. But if the price takes a long time to come back to that zone, then it is a weak zone. So I hope you like this video. So if you have any questions, please comment down below and I would love to answer them. Also, you can join our free Telegram group in which we share Forex trading knowledge for free. Also, don't forget to subscribe to our channel so that you'll be the first one to not be notified whenever we upload new content. And you can also visit our website www.forexb.co in order to learn more about forex and price action. See you guys in the next video. Thank you.
Hey guys, welcome back. So today we're back with another good news, and we're going to launch our supply and demand indicator today. So we've been working on this indicator for almost 2 months, and the good news is that the backtesting results of the supply and demand indicator are awesome, as you're going to see in this video. So without any further ado, let's get started. The first thing that we're going to do is we're going to clear some basic concepts of what supply and demand zones are. Okay, if you have seen our recent videos, you must have an idea about them, but if not, I'm going to explain in this video as well. Okay, so first of all, we'll go through the supply and demand zones, and then I'm going to show you how the indicator draws the supply and demand zones in real time on the charts, and I'm also going to explain a strategy using which you'll be able to take pinpoint entries for your trades, which will have small stop losses but very high risk rewards. So let's get started. So here on the screen you can see that I have some drawing, and these drawings are about supply and demand zone. First of all, what is supply or demand zone? Okay, a demand zone is when there are a lot of people in the market who are willing to buy and there is not enough supply. So what it creates is it creates a demand, and then the prices rise. And what supply means is when there are a lot of people who are willing to sell and there are not enough buyers. This causes the prices to drop. Okay, so these are the basic concepts. Now let's see how it works in trading. So first of all, here you can see that this one here is the rally base rally demand zone. Now all the zones, there are 4 types of zones. The first one is rally base rally demand zone. The second one you can see here is the rally based drop supply zone. The third one is drop based rally demand zone, and the fourth one is drop based drop supply zone. Now, as I just said, at demand zone there are a lot of people who are willing to buy, and at supply zone there are a lot of people who are willing to sell. So first of all, let's talk about the demand zones. Here you can see that this is a rally based rally demand zone, and in rally based rally demand zone the first candle is a big bullish candle, as you can see here. And then the second candle is a small candle which has small body but long shadows. Then the third candle is again a very big bullish candle. So this one is rally, this one is base, and this one is again rally. This is a rally base rally demand zone. Now the zone will be drawn at the highs and the lows of this base candle. At this zone, what institutions do is they place their pending buy orders at demand zone. So for us as retail traders, it creates an opportunity to take pinpoint entries and get high risk reward trades. Okay, so as you can see here, that at this rally base rally demand zone, what market will do is after going in the bullish direction, after the formation of rally based rally demand zone, market will eventually come back in order to pick the pending orders that were placed by institution, which created the demand. And then from after picking those pending orders, what market will do is it will move in the bullish trend. Now let's talk about the supply zones. At supply zone, there are 2 types of supply zone. The first one is drop based drop, and the second one is rally based drop. So let's talk about the drop based drop supply zone. In drop based drop supply zone, the first candle is a big bearish candle, okay, which represents a big bearish move by the sellers. That means that sellers have the momentum right now. And then the second candle is a small bodied candle which has very small body but long shadows. And the third one candle, or the last candle, is again a very big bearish candle. So this is a supply zone. Now just like demand zone, the institutions place their sell orders at supply zones, and after the formation of supply zone, market goes back eventually to the supply zone in order to pick those pending order, and it creates an opportunity for the retail traders to also here take the pinpoint entries for high risk reward trades. So after the formation of supply zone, you can place a pending sell order, and when market comes back in order to pick those pending orders, after picking those orders or after fulfilling those orders, market will go in the bearish trend. Okay, so this is how supply and demand zones work. And similar to this drop based drop supply zone, the rally based drop supply zone works in similar manner, and this drop based rally demand zone works in similar manner to the rally supply zone. The trading psychology behind these zones is same. Okay, the demand zones, no matter what type it is, the trading strategy behind that is same, only the market structure is different. So in both these demand zones we will place the pending buy orders, and in both these supply zones we will place the pending sell orders. Okay, now I'm going to show you how the supply and demand indicator that we developed can help you identify these zones real quick, and also it will show you the results in real time. It will draw the zones in real time. So let's apply the indicator to the charts. So in order to apply the indicator, I'm going to go towards this indicators, and I'm going to go towards this indicator supply and demand indicator version 1, and let me just put in the values, and I'm going to hit apply. So here you can see I have applied the supply and demand indicator, and let's talk about these one by one. These labels represent where the zones are. Okay, whenever the indicator detects any zone, it will draw a label on that. Okay, and here you can see the table. We're going to talk about this as well, what information this table contains. And then here you can see the indicator drawing the supply and demand zones in real time. So let's backtest this indicator. Let me just hit the replay bar, and let me go here. So here when we see that when we replay the market, the supply and demand indicator will identify the supply and demand zones for you. So let me just hit replay, and here you can see the indicator detected a rally based drop supply zone, and it drew a label as well. And here let me just zoom in. Let me just decrease the opacity here. So here you can see the indicator has detected a rally based drop supply zone, and as we discussed earlier that rally based drop supply zone, the first candle is a big bullish candle, and then there are base candles, and then again the last candle is a big bearish candle. This represents that there is a supply zone created in the market. So here what institutions will do is they will place their pending sell orders, and market is gonna come back to this zone in order to pick those orders. So let's see how it goes. Okay, let me just forward play this market. So here we can see that at this point the market came back to this zone, this supply zone. Okay, so now here the market has picked the pending orders that were placed here at this supply zone, and if I forward play this, here you can see that the market picked the pending orders, and then after that it gave a very big bearish move. Market from this level, market came to this level. Okay, so this is a high risk reward trading setup. Okay, because the stop loss is very small and the profit is from this level to this level. Now let's keep playing the market in the forward direction. So if I hit on play, it's gonna move, and let me just increase the speed. So here you can see the indicator has detected another rally based drop supply zone, and this rally based drop supply zone is very similar to what you saw in the drawing, and it has drawn a label. So another thing that you have noticed is that as soon as it detected the second zone, the first zone was removed and it only kept the label on that. Okay, so what indicator does is it draws the zones in real time, and only the latest zones are drawn. Okay, but it keeps a historical reference to where the last zone was. Okay, so here you can see that the last zone, the last rally based drop zone, is still there. It is represented by this rally based drop supply zone label, and then this is the latest zone. Okay, now let's move this, or let's forward play the market, and here you can see that at this zone the market came to this level in order to pick the pending orders on very next candle, and after picking those orders, market gave a very big bearish move. Now let me just forward play this, and here you can see at this supply zone again the entry is at this level and the stop loss will be at this level. So this is again a very high risk reward trading setup. Let me just forward play the market in the forward direction. So let's forward play it, and again another zone is detected, that is our rally based drop supply zone, and at this zone as well the market the indicator is drawing the zone in real time, and after the formation of zone the market came back in order to pick the pending orders here, and after that it's going to move in the bearish direction. So let me just forward play the market. Now see how awesome this is. Okay, because the stop loss in this zone as well is very small, but the indicator is giving us a signal that we should sell here, and the risk reward is very high from this to this. So this is a very good trading setup as well. Okay, and now let's talk about the table that is being drawn here. So in this table, what indicator does is it gives us the zone high. Let me just go here just to give you an example. So here you can see that this is our rally based drop supply zone, and this is the high of this zone, and this is the low of this zone. So the indicator is giving us the values of this rally based drop supply zone. As you can see here, the high value is this. Let me just show you as well, and the low value is 1.85404, as you can see here. Okay, so the indicator is giving us the values of latest zones in real time in this table, and this last row here, it represents what trend is going on in the market, because if the daily trend is bearish, then you should be in favor of taking bearish trades, and if the daily trend is bullish, then it's good to take the long positions. Okay, so this is how the indicator works. Now let me just show you the settings of the indicator, and let me just go here. Now in the settings, you get very good features, which are you can change the candle body size. Okay, candle body size percentage. Now what it does is it allows you to draw unlimited supply zones and unlimited demand zones, because you can try any combination you want. Okay, you can put in any combination of big and small bodied candles percentages you want to, and then the indicator will give you the results in real time. It will draw the supply and demand zones by the specified percentages that you will put inside your indicator setting. Now here you can see I have put the 62 for a big body candle percentage, which means that the overall body of this candle should be greater than 62%. As you can see here, that the body of this candle is greater than 62%. And then I have also put the small body candle body percentage should be less than 25. Now here you can see that the size of this candle, the body of this candle is less than 25%. So specifying these values, by specifying these values, you can draw unlimited supply and demand zones, and also the indicator will show you the past supply and demand zones, and also draw the real-time supply and demand zones on your charts. We have also added the feature where you can customize the colors of the indicator. All the drawings and all the labels, table, and every cell is customizable. Okay, you can customize the colors of the indicator as the way you like see fit. Okay, because some people might like other colors. I would highly recommend you to use green color for demand zones and red color for supply zones. Okay, because it makes a lot of sense. Demand represents that we should go in the buy, okay, or we should buy, and then sell, the supply zone represents we should sell. Okay, so it makes a lot of sense to keep them green and red, which are default, but you can change them as well from your TradingView indicator settings. Now here we have added the option to show or hide any zone you want to. So if I go here and let me just go to settings, so here you can see that rally based drop supply zone is forming. If I go inside the indicator settings and I want to, for some reason, I want to hide this rally based drop supply zone, I don't want to see it in real time, what I can do is I can just go inside the indicator settings and click on this, uncheck this supply show rally based drop supply zone, and when I hit OK, it's gonna disappear. As you can see here, now the zone is gone because indicator has hidden that zone. You can uncheck the boxes you want to, and indicator will hide those zones for you. Okay, and in the end you get an option to show or hide the table. If for some reason you want to hide this table, you have an option. Okay, you can uncheck this box and indicator will hide this table. So here you can see that table is gone, and if we want to bring the table back, we can just go into settings and click on check this show table, and the table will show up again. So these are all the features that we have added into our supply and demand indicator, and we're constantly working on this indicator in order to add more confluences and more features, which will be very helpful to you. And if you're interested in getting this indicator, the links are in the description, or you can also click the link above, and then it will take you to the page where you can see how you can get this indicator in tradingview.com. Hey guys, welcome back. So today in this video we're going to talk about how our supply and demand indicator is performing and how it's drawing the real-time supply and demand zones in the charts, and how you can benefit from those supply and demand zones as well. So there are certain reasons why you should trade with supply and demand indicator, okay? And because the supply and demand indicator is the basics of every financial market, and I'm going to show you what are some reasons, and then I'm going to show you why and how it is performing so well, okay? So let me just go here, and here we can see that first thing is it offers a very high risk to reward ratio, because the supply and demand, as I just said, is the basics of any financial market, and the market always follows the basic rules of supply and demand. So the first thing is that it offers a very high risk to reward ratio because the stop losses are very small, and it allows us to take pinpoint entries. The second thing is best confluence in trading strategy. So whenever you're trading with any strategy that you have developed, you should use the supply and demand indicator, because it can act as a very good confluence in order to favor your trade or favor your analysis that you have done. And if by applying the supply and demand indicator, if you find a zone or a confluence that is resonating with your analysis, then that can increase the probability of your trade winning even more, okay? And the third thing is it allows us tight stop loss levels. As I just said, it gives us the pinpoint entries, and the stop loss of the supply and demand zones is always very small as compared to other trading strategies that are available in the market or that you can develop. And the fourth one is it helps in risk management because it has a fixed stop loss. In cases where you have a trailing stop loss in which you have to change your stop loss depending upon the situation, in that case your risk management gets destroyed. But in case of supply and demand indicator, it can help you give the fixed stop loss, and it allows for better risk management because then you're just treating one stop loss instead of changing your stop loss with each swing in the market or each change in the market. So now let's go towards the charts and see how the indicator is performing. So if we go towards here, we can see that this is the real-time chart, and the indicator plotted a rally base drop supply zone, because you can see there is the first big candle or bullish candle, and then these are the base candles, and then again there is the drop candle or bearish candle. So this is our rally base drop supply zone, and this means that now the supply zone has been created and market is going to come back in order to pick the pending orders from this supply zone, which it did. And here you can see after the formation of supply zone, the indicator started drawing the supply zone in real time, and as soon as this candle closed, it started drawing the supply zone. And it also can give you a notification if you set up the notifications from this alerts tab. So here, after the formation of supply zone, the market came back in order to pick the pending orders that were placed by the institutions, and then you can see how much in the bearish direction the market has moved. Now, as we discussed in the above points, that it allows us to take high risk to reward entries. Let me just show you what I meant there. So let me just go here, and if I take the short position here, and let me just draw. So our stop loss would be just above the high of our supply zone, and our take profit, as you can see here, can go towards even 7.34, so which is very good risk to reward ratio, and our stop loss is very small as compared to the profit or the risk to reward ratio that you're getting. So let me just remove this. In the previous trade or in the previous signal that you can see here, the indicator had drawn the rally base and rally demand zone, and the trading psychology or the market structure of demand zone allows us to detect that here the markets or the institutions are going to place their pending orders. So after the formation of this rally base rally demand zone, the market came back in order to pick those pending orders right after in the next candle, and from here you can see the market moved in the bullish direction till this level, which is again very good. And I also said in past videos about supply demand that markets always move from zone to zone. As you can see here, that this is the demand zone and this is the supply zone. So market gave a bullish move from this zone to this zone, and after that, after the formation of the supply zone, the market started moving in the bearish direction. That also proves out to be correct, that market moves from one zone to another zone. So here again, In this case of rally demand zone, the market picked the pending orders right in the next candle, and it gave us a very big bullish move, and our stop loss again is very tight, and our risk to reward ratio is very good. Let me just take the long position here, and let me just draw. So if I put my stop loss just below the low of our demand zone, and we could have achieved the profit till the risk to reward ratio of 5.52, which is again very good. And let me just go back and show you again in the past signal or another signal. Here you can see that the indicator is showing us that there is, let me just bring this front, the indicator is showing us that there is a base drop supply zone. And as I just said, in case of previous supply zone as well, in this supply zone the market will come back in order to pick the pending order, which it did here. So in this case here, there is a small movement in the bearish direction after picking the pending orders, but still it is almost 1 to 1 risk to reward ratio. If I just take the short position here, and you can see that it is still almost 1:1 movement, which is not bad. Okay, but I would say it's not a very good trading setup like in this case here, but it's still, it did give the bearish move. And let me just go back. Here's another rally demand zone, and if I just go here, you can see the market came back in order to pick the pending orders from this zone, because the zone level would have been here. You cannot see the drawing of this zone because indicator draws the real-time zones. As you can see here, there's already another rally zone present. So as soon as this zone was detected, the indicator stops drawing this one and starts drawing this zone. And also this zone was invalidated when this candle closed above. But here, when this zone was formed, you can see the market also gave a bullish move from here to here, which is again a very good. Okay, and it's still profit of 1:1 or even greater. So let me just go back, and here you can see the formation of another drop based rally demand zone. Now, as I explained earlier, that in demand zones the market will come back in order to pick the pending orders, and then will give a bullish move. So if I zoom out, you can see here that this zone was fresh till this level, and here the market came back in order to pick those pending orders, and then after you can see that it gave a very big bullish move. So again, the supply and demand indicator allowed us to take the pinpoint entry. As you can see here, as soon as the demand found, we would have put our pending buy order and put our stop loss at this level and put our take profit at whatever the percentage or whatever strategy you're using. So this can also, like here, the market came back in order to pick the pending orders, and then after that it moved in the bullish market. So let me just show you what would have been the risk to reward ratio in this case. So let me just zoom out, and our target could have been anywhere around that. So that's an almost 11 per risk to reward ratio, which is again very good. Okay, and if we go back and see here, you can see that there's formation of rally based drop supply zone, and from here the market came back in order to pick the pending order from this level, as you can see here, and then gave a bearish move. If you want to see this zone, what we can do is replay the market. So let me just go here and replay till this level. So here you can see that this is the supply zone forming here, and market came back in order to pick the pending order, and then after that it gave a big bearish move, and this is still a very good risk to reward ratio. Okay, and our stop loss would have been above this, so this is still a very good risk to reward ratio. And let me just close this. No, and if I want to, let me just close this. So if we move even a bit backward, you can see here that in this case the market, the indicator detected a drop based rally demand zone. Right off in the next candle, the market came back in order to pick this pending order in this candle, and then you can see the risk to reward ratio in this case as well. If I just draw here, if I draw the long position, and if I put our stop loss just at this level, just below our demand zone, and our target would have been somewhere around that. So this is again another trade with a risk to reward ratio greater than 10, and this is very good and very effective trading strategy. And you can also use the supply and demand zones as a confluence in your trading, because if you have detected any candlestick pattern or any chart pattern and you want to see if the trend will get reversed or not, or if you want to see like the trend will continue, you can use the supply and demand zones as a confluences and see if there is a supply or demand zone in the past at the same level at which your candlestick pattern is detected or any chart pattern is detected. And that can be a very good confirmation of if the market will move in the bearish direction or in the bullish direction, and like if the trend will get reversed or not. And if you are interested in getting this indicator, the links are in the description. You can visit our website www.forexb.co in order to learn more about the indicator, and I'll put the links in the description as well. Hey guys, welcome back. So in this video we're going to talk about the two key levels that are mostly used inside trading, and we're going to talk in detail about what is the market structure behind them and what is the trading psychology behind them. So we're going to talk about the support and resistance and supply and demand and their differences, okay, because both of them are very important and people use it for different purposes. So first, here we can see that first we're going to go through what are demand zones. Now, as I said, the market structure of a demand zone or support zone is very different, and also the trading psychology behind a demand zone and support zone is very different. So first we're going to go through the demand zone. In this case here we can see that this is a demand zone forming here. This is a rally base rally demand zone. Now as we can see, this consists of three market phases. The first phase is the rally, then second one is the base, and the third one again is rally. So in the first and third phase, the market is in very good momentum, or the buyers are in very good momentum who are pushing the market in the bullish direction, okay? But in this second phase here, the market gives a kind of pause where the market is making a range. So with the first phase, the market is in very big bullish momentum. Then there's a pause, and after that there's again a very big bullish momentum. So the institutions look for these trading zones or these demand zones to put their pending buy orders so that market can come back in future in order to pick those pending orders. We're going to talk about it in detail later in the video as well. Now here, this is the second type of demand zone in which we can see that this is a drop, base, and rally demand zone. Now in this demand zone, the market structure is that in the first phase, the sellers are in very good momentum, okay, and they're driving the market in the bearish direction. After that, there's a pause or there's a range in the market in which both the supply and demand are balanced, but here again a lot of buyers come in increasing the price, okay, raising the bullish trend. So this is a drop, base, rally demand zone, and the institutions look for these zones in order to put their pending orders so that they can be picked up by the market in the future, okay? So this is the market structure of a demand zone. Now let's talk about what is the trading psychology and how institutions use these demand zones for their trading. So once a demand zone is created, as you can see here, our demand zone would be around the high and low of the base candles or the base region, okay? And what institutions would do, they would put their pending orders at this demand zone. So after the formation of the demand zone, the market is likely to come back here in order to pick those pending orders that are placed, and then after that it will again give a very big bullish move, okay? So this is the trading psychology behind the demand zone, and similar is the case here. In this case, the drop, base, rally demand zone, the institutions will put their pending buy orders at the top or high of this base zone, to which the market will come back in the future and it will pick up those pending orders and then again move in the bullish trend, okay, with a very good impulsive move. And these lows of our demand zones act as our stop loss or levels as well. So this is the trading psychology and this is the market structure behind a demand zone. Now let's talk about the support zone. Now these zones or support zones are very dynamic because you can find them at any place where the market is bouncing back from a certain level, okay? It does not require a specific type of market structure in which we have to look for any percentage of like the body or percentage of candle or anything. These are the levels that are very interesting to the market or very interesting for the buyers, because buyers use these levels as a reference to where they can place or they can rely on. Okay, so here you can see the market is in bearish trend, and after that it bounced from here and went in the bullish trend. Now again, after market came back to this level, and then again it bounced back. So this level is interesting for buyers because most of the traders are using these levels, and market is bouncing back from this level again and again. So what happens is the support is there, which is rejecting the price, and it doesn't let the price to go any further down from this level. So that's why the market keeps bouncing. So here sellers push the market downwards, but again the market finds a support at this level, okay, and then it bounces back. The sellers come back again in order to break this level, and then the support zone supports the market, and the market again goes in the bullish trend. So the sellers are not able to take control of the market or break this zone. Now with time, of course, like the more the market tests a certain zone, the more weaker it becomes. So with the time, this zone will become weaker and weaker, and ultimately it will break. But you can see the market structure of a support zone is where the price is getting rejected again and again, and market is coming to that zone but again bouncing back. Here you can see that there are 4 price bounces at this zone, support zone here. So this is the market structure, and the traders, these levels are important to traders because they use them to put their buy orders. Okay, now let's go through the charts in order to see some real life examples of how supply and demand zones and support or resistance zones are traded. So let me just go to his charts below here, and here we can see the formation of a support zone, because we can see the market is getting rejected from this level again and again. Here you can see this is the first touch, second, third, fourth. So like the market is coming down, but it finds a support at this level. That's why it gets rejected. The sellers get rejected, and the market goes in the bullish trend again. Now again, market comes back to test this zone. If it can either break this or bounce back. So what happens is it bounces back because the market finds a very good support at this level. So this is the support zone. Okay, and the market structure, as I explained above, is that here this level is interesting to buyers because a lot of buyers would be willing to put their buy orders at this level, okay, or use this level as a support in the market. And here we can see that this is the demand zone. We also have a supply and demand zone indicator, which you can use in order to detect the supply and demand zones automatically. I'll put the link to that in the description, so please make sure to check that out as well. So here we can see the formation of demand zone, that is our rally base rally demand zone. And now, as I explained earlier, once a demand zone is formed, the market will come back in order to pick the pending orders from that zone. So here you can see the demand zone is forming here, which is rally base rally demand zone. And after the formation of demand zone, the market kept moving above that demand zone, but ultimately it came back in order to pick the pending orders, and then after that it gave a very big impulsive bullish move. Okay, so the supply or demand zone is fresh until it's picked, okay, until the market comes back and picks the orders and goes in the bullish direction. And here in case of support zone, the market keeps retesting that zone until it breaks it. Okay, so these are two main differences that exist between support zone and demand zone. Now let's talk about the resistance zone and the supply zone. So let me just go here. Here you can see that this is the resistance zone forming here, in which the price is getting rejected. The buyers are trying to break this level, but the price is getting rejected again and again. Let me just zoom in. So here you can see that price is getting rejected and market comes back but gets rejected and then again moves in the bearish direction. So similar to the support zone, in the resistance zone, the market keeps retesting that level. Okay, and this level is also very important to the sellers. And here you can see the formation of a supply zone, in which we can see that this is a drop supply zone. And after the formation of supply zone, the market came back in order to pick the pending orders at this level once, and then after that it gave a very big bearish move. So if I want to put it in a nutshell, it would be that at support or a resistance zone, the market keeps retesting those levels, okay? But in case of a supply or demand zone, the market, once the demand or supply zone is formed, the market will come back in order to pick that pending orders that are placed by the institutions, and then it will move in the, if it's a demand zone, it will move in the bullish trend after picking the buy orders, and if it's a supply zone, the market will pick the sell orders or pending sell orders and move in the bearish trend. So that is the main difference between support and resistance and supply and demand zone. Be sure to check the supply and demand indicator in the description, and I hope you guys like this video. If you have any questions, please comment down below. I would love to answer them. Also, don't forget to subscribe, and see you guys in the next video. Thank you. Hey guys, welcome back. Today in this video we are gonna talk about the importance of time when you're trading the supply and demand zones. So without any further ado, let's get started. The first thing that you need to understand before going into why time is important is understanding how supply and demand zones are formed. And we have made a separate video which I'll link in the description. So please go ahead and watch that if you already don't know the types of supply and demand zones and how they're formed. So here, let's say that we have a demand zone. Now, as soon as the demand zone is formed, let me just zoom in through charts. And here we can see that there is this rally base and rally demand zone, and that demand zone is drawn at the high and low of the base region. So at the close of this bullish candle, the zone was complete and this zone is formed. Now on the very next candle, we see that the market picked the pending orders and then gave this very impulsive move in the bullish direction, and there are multiple candles that show us that buyers are in very good momentum after picking the orders from this demand zone. Now this order was picked up instantly after the formation of this demand zone, and this worked out in our favor. Now if we talk about when the price came back again, here we can see that over time the zone became weak, and this is the main agenda of this video, that as time passes by, the buyers, if it's a demand zone, then the buyers, and if it's a supply zone, then sellers will lose interest and they will start looking for other levels. So here, let's say that zone formed here, and as market kept going upward and it did not come back. So with the passage of time, the buyers or and the sellers will lose interest in this zone. They will start detecting the other zones and other key levels. And when the market comes back, as you can see here, after picking, it did bounce a little bit in the bullish direction, but this zone failed here, and we can see that the market just broke this zone. So this is because the market came back after a lot of time. As you can see here, the zone was formed on August 10th of August at 4, and the market picked the orders right away, but then it came back again here in this area, and then here the zone was broken. So let's take another example to understand it a little bit more clearly. Here we can see that there's this supply zone. Okay, so at the supply zone, and this is our rally base drop supply zone. So at this supply zone, the forecast is that the market will come back now to pick the pending sell orders of the institutions, and then it will give a very impulsive bearish move. Now let's see what happens. As the time passes by, the market did not come back, and it did come back here, but here it just broke this zone and it went through this zone. So again, since the market took a lot of time in order to come back, the zone did not remain valid anymore, and because the market took a lot of time, and the price just went through this zone. So the price took time to fill the orders at supply zone, and the zone failed. So now let me show you the zones where the market came back right away in order to pick the pending orders, and those zones worked really well. Now here, as we can see, that in this zone there's again a rally base rally demand zone, and after the formation of zone at the close of this candle, the market went a little bit in the bullish direction and then came back in order to pick the pending buy orders. Now after picking these orders, market gave this very impulsive move. Now as you can see here, when we would be trading this zone, we would put our entry here, put our stop loss here, and our take profit would be according to the
strategy that comes with the supply and demand indicator. By the way, you can also use our supply and demand indicator to find the supply and demand zones automatically on your chart for you. If you are interested, please check the link in the description. Now, as you can see here, according to the demand zone strategy, our stop loss would be here, and as I said, our entry would be here, and the market kept going in the bullish direction till this level. So this would have been a very good trade because the market came back right away after some time and it picked the pending orders. Now what we learn from this is that as the time passes by, the buyers or sellers lose interest because they are more interested in finding the latest levels as the price action is happening. So what we can deduct from this discussion is that the time is inversely proportional to the interest of buyers, sellers, or sellers to buy or sell from a particular key level or particular price. So this is the main idea, that once you have found the zone, if the market does not come back after right away after within short time, then you should not trade that zone because it would not work out very well in your favor. And when the market comes back, then you should make sure that the zone is fresh. You should not trade the zone from which the market has already picked the pending orders. So now let me go through a few examples that I have drawn here to show you how the trades are working. So here we can see that this is the supply zone. The market picked the pending orders from here, and then it went in the bearish direction, as you can see here. So these orders were filled right away, and then market moved in the bearish direction. If we keep moving forward, we can see here that the demand zone was formed here, and this is our drop base rally demand zone, and the buy orders were filled right in the very next candle. So the market gave this bullish move in the bullish direction. So this again a very good demand zone, and this again a very good place for market to come back to pick the pending orders. And now if we keep moving forward, we can see here that at this zone, at this demand zone, this rally base rally demand zone, the orders were picked right away in the very next candle, and that's why you can see the formation of this very impulsive bullish candle. And from this level to this level, the market did give a very impulsive bullish move. Now if we keep looking forward, you can again see that at this supply zone, the orders are filled right away in the very next candle, and then market gave this impulsive bearish move. And in this demand zone, the market picked the pending orders from this very next candle, and then again gave this very bullish, big bullish move in the bullish direction. So I hope you're able to understand that when the time passes, as the time passes by, the buyers and sellers lose interest, and you should take that into account when you're trading the supply and demand zones. And you should always look for the supply and demand zone trades when the zones are fresh and market is coming back in order to pick the pending orders right after the formation of the supply or demand zone.
It's very easy to lose money in any financial market, but if you learn the core concepts of supply and demand and how it determines the market prices, you will be able to profit consistently by following the institutional traders who control the market. In this video, we will be going into the details by profitably detecting and trading supply and demand zones for day trading. We will also be revealing to you the advanced strategy that took us years to learn, and now you'll be able to learn it in 15 minutes. And towards the end, we will also show you how by using different confluences you can increase the winning probability of your other strategies as well. But before we get started with the video, please click the subscribe button and press the bell icon to get notified, because we have a lot of great content planned in upcoming videos that you never want to miss. So without any further ado, let's get started. The first thing that we will cover in this video is understanding why you need to learn supply and demand. Forex is a $6.6 trillion market, and retail traders with a percentage of 5.5% do not have enough volume to move the market in desired direction. Rest of 94.5% of the market is institutions, which includes hedge funds, investment managers, multinational corporations, and central banks. So as a retail trader, it's only wise to trade with institutions because you have a great edge over other retail traders. Now let's dive into learning the supply and demand. The driving force behind the changes in price in any market is supply and demand. Market has generally one of these two phases at all times. The first one is the balanced state, in which the market is moving inside a range and there are no impulsive moves or gaps in the market. This represents that the forces of buyers and sellers are equal, and market makes this ranging structure. The second phase is the unbalanced state, in which the number of buyers and sellers are not equal, and it is in this state where the supply and demand zones are formed. And in the unbalanced state, the market or the price will move very impulsively in either bullish or bearish direction. So when there are more buyers than sellers, the market prices will move up, and this means that there is demand in the market. Conversely, if when there are more sellers than buyers, then the market prices will move down, and that means there is a lot of supply in the market. These simple concepts are very powerful and allow us to analyze the naked charts and determine where the price is likely to go. Let's understand this through an example. Let's say that a company releases a new tablet computer. If these tablets can't move at the price at which they are being sold, then the prices will drop because very less people are willing to pay that much and buy the tablets at current price. And the company will have to decrease the price to sell these tablets. The price will continue to drop until the price finds the balance with which the buyers are willing to pay. So you see how the increased supply of tablets with less number of buyers decreases the price. So this is the effect of the supply on the market. Conversely, if there are more buyers than the tablets that are being produced by the company, the prices will rise because there is a lot of demand in the market. So we can say that these two things are very prominent in supply and demand. Number one, the buyers dictate the demand in the market and the sellers dictate the supply in the market. So now that you know about how supply and demand moves the markets, we would want to detect the supply and demand zones so that we can trade with institutions and generate profits while day trading. And as a side note, supply and demand zones are forming almost at all time frames. But to be a profitable day trader, I would recommend you to trade supply and demand zones at time frames above 30 minutes. There are two types of supply and demand zones. First, we're going to go into the details of demand zones. In the demand zone, there are three market phases. The market structure of a demand zone looks like this. Here, the first phase is an impulsive move in the bullish direction, which represents the huge momentum of buyers. This phase is called rally. So in the first phase, the buyer controls the market. The second phase consists of a ranging market structure in which the number of buyers and number of sellers are almost equal, which means currently the market is in indecision phase, and this phase is called base. Then in the third phase, the market again moves impulsively in the bullish direction, showing the dominance of buyers, and this phase is called the rally. So this is the market structure of a rally, base, rally, demand zone, and the zone will be drawn at the boundaries of the second phase or the base region. As you can see, the high of this base is the high of the demand zone, and the low of this base will act as a low of our demand zone. The second type of demand zone is drop, base, rally, demand zone. And in the market structure of a drop, base, rally, demand zone, the first phase is an impulsive move in the bearish direction. This is called the drop. The second phase is a ranging market structure called the base, and the third phase is again an impulsive bullish move. The drop, base, rally, demand zone will also be drawn at the highs and lows of the base zone. So there are two types of demand zones, the rally base rally and the drop base rally. By the way, we also have a supply and demand indicator which can help you detect the supply and demand zones automatically on the charts in real time. And it comes with the powerful features like custom candle body sizes and real-time alerts. So as a day trader, it can help you save time and effort. I have put the link to the indicator in the description, so if you're interested, please make sure to check that out. Now let's move towards the supply zones. Similar to demand zones, there are two types of supply zones: the drop-based drop and rally-based drop. In the drop-based drop, the first phase is an impulsive bearish move, which shows that the sellers are driving the market in bearish direction. The second phase is a ranging structure called the base, and the number of buyers and number of sellers in this phase are almost equal. And the third phase is again a bearish impulsive move in showing the dominance of sellers. In rally based drop, the first phase is an impulsive move, then the second phase the market is ranging, and in the third phase there is again an impulsive bearish move. So the two types of supply zones are drop based drop and rally based rally. To trade the supply and demand zones, we first detect the zones, and if it's a demand zone, we will put the pending buy order at that zone, and if it's a supply zone, we will put the pending sell order on that zone. After the formation of the zone, the market will come back to that zone to pick these pending orders placed by the institutions, and within that, our pending orders will also get fulfilled. Let's see this through an example. To detect the supply and demand zones, there are two ways. One way is to detect the supply and demand zones manually, and the second one is that you can use the supply and demand zone indicator to detect the zones automatically on your charts. But before we start drawing the zones on the chart, we should know that the impulsive moves, which represent the rally and drop phases, are represented by the candles on higher time frame with a high body to wick ratio. For example, here is a candle in which the total candle is from this high to low, okay, and this is called the range of the candle. The actual body of the candle is between open and close. So if we want to calculate the body percentage of this candle, we can divide the number of pips of the body by the number of pips in the total range of the candle and multiply it by 100 to get the percentage of the body in the candle. So after calculating the body percentage of the candle, we should keep that in mind, that the body percentage of drop and rally candles should be greater than 60, so that it should represent the clear or huge momentum, and the body percentage of base region candles should be less than 30%, representing the ranging market. So here on the charts, we can see the formation of this rally base rally demand zone, and as we discussed earlier, we can draw the zone at highs and lows of these base candles. This is how we can manually detect the zones. The second way is we can just use the supply and demand indicator. So when I go to the charts and apply the indicator to the charts, here we can see that it starts to show the supply and demand zones. So in order to trade this demand zone, we'll put the buy limit order at the high of this zone and put the stop loss at the low of this zone. So after the formation of the demand zone, the market will move up and then it will come back in order to pick those pending orders. After picking the pending buy orders, the market will move up. Now let's go through an example of a supply zone. Here you can see the formation of a drop base drop supply zone, and the supply zone is around the base candles. In order to trade this supply zone, we will put the sell limit order at the low of the supply zone, and the market after the formation of the zone will move down and then come back in order to pick the pending orders and then again move in the bearish direction. This is how you can trade supply and demand zones. Now let's talk about how you can increase the winning probability for trading supply and demand zones, and as a day trader this is important. So what you can do is you can set your charts to daily time frame and see if you can spot any supply or demand zone there. In order to do this automatically, you can use the supply and demand indicator as well. For example, here we can see the formation of a supply zone at daily time frame, and after picking the pending orders from the supply zone, the market is headed in the bearish direction. So when we go towards a lower time frame and see any supply zone forming, we should be comfortable to trade that because the price is already moving in the bearish direction at daily time frame. Another way to trade supply and demand zones as a day trader is that when you detect a zone on the charts, then you should look for key levels in the past. And if you spot any key level at the same level where the zone is, your chances of making profits from that trade will increase. So I hope you guys like this video. Please make sure to comment if you have any questions, and also subscribe and like this video. Hey guys, welcome back. So in this video we're going to talk about how you can combine the Fibonacci zones plus supply and demand zones in order to make a very powerful trading strategy. Okay, so if we talk about supply and demand zones, these are the zones that you can find on the charts, and there are different types of supply and demand zones. Okay, we have covered all of them in detail in our previous videos. So the supply and demand zones have a moderate winning probability. Okay, and if we talk about the Fibonacci zone, they are also zone between the level of 50 to 61.8 Fibonacci. Okay, so in between those ratios, that zone is called the golden ratio zone, and that zone also has a very moderate winning probability. So now separately, these two zones have winning probability that is moderate, but if we combine these two zones, we can increase the winning probability of the final setup that will form. Okay, so if we want to make a statement in this video, that would be the number of confluences is proportional to your winning probability. Now there is one thing that you should keep in mind, that you should not add like more than 3 confluences to your trading strategy, because if you are keep on adding confluences, the chances of your strategy winning will increase. But in the end, if you, let's say, have added 5 to 6 confluences, then you are hardly going to find any trading setups that meet all the requirements or all the confluences that you have added. So make sure not to overdo it, because that can also decrease your trading opportunities. So here, if we go into detail of here, you can see that there's a supply demand zone forming here. So this demand zone has a moderate winning probability. Okay, but if we combine it with Fibonacci, because here in this one we are trading this zone alone, there are possibilities that price may come down to pick the pending orders and then move in the bullish direction, but it can also break this zone and that zone would not be valid anymore. But here in this case, we are combining the demand zone with the Fibonacci zone. Okay, so if I take the Fibonacci tool and draw the Fibonacci ratio from here to here, we can see that this demand zone is forming between the Fibonacci zone. Okay, so here the Fibonacci zone is 0.5 to 0.618 level. So this demand zone is on the same level of the Fibonacci zone, which means now the winning probability of this trading setup is much higher than if we were trading the demand zone alone. Okay, and we're going to talk about and we're going to see this in the example as well. Hey guys, I'm cutting this video to announce that we also have a supply and demand indicator which you can use in order to detect the supply and demand zones automatically on your charts. We have this indicator available on TradingView. Here you can see the demo in this video as well. So make sure to check the links in the description. Here you can see that if I just zoom in a little bit, I can see the formation of a demand zone that is a rally base rally demand zone. So let me just draw the zone for you. So here, this is a rally base rally demand zone. Now if the high of this base zone will be the high of our zone, and the low of this base zone will be the low of our demand zone. Okay, so there are 2 candles inside this rally base rally demand zone. Now here we can extend it in the future to see how it's performing. And now, as I was saying, we're going to combine 2 trading setups. The first one is this demand zone, and the second one is going to be the Fibonacci zone. So if I take the Fibonacci tool and draw from this swing, this wave, from this swing low to swing high, we can see that the Fibonacci zone is also forming at the same area where the demand zone is forming. So what that means is now we have combined two trading setups, or we have added a confluence of a demand zone to our supply and demand. Okay, and here in this case the demand zone is forming at the same level at which the golden zone is for the Fibonacci ratios. So now the winning probability of this setup is much higher than if we were trading any of these two alone. And in the future we can see that the price bounced from this zone multiple times. As you can see here, this is the first time that where it touched the zone, then it bounced till this level, then again it touched the zone here, and then it gave a bullish move. And if we extend it a little bit further in the future as well, we can see that the price bounced from this zone 1, 2, 3, 4 times. Okay, which is a very good trading setup. So this is how you can combine the Fibonacci zones and the supply or demand zones in your trading setups. Here, as I was saying, you should also be looking for any other like confluence that you can add, but always keep that in mind that you should not increase the number of confluences to anywhere above 3, because that would decrease the probability of you finding trading setups. So in this case as well, there's a third confluence as well, which is this swing high, which is acting as key level. Okay, so if I just draw a horizontal line here, we can see that this is also a key level. So with these three confluences, this price level is very important, and it has proved it in the future that the price is bouncing from this key level multiple times, as we can see here. So this is how you can increase the probability of your supply or demand zones. Okay, so let me just revise what we have discussed in this video so far. Okay, first of all, we talked about what is supply zone and demand zones and what are Fibonacci zones. Okay, the Fibonacci zones are the zones that are between 50 to 61.8 Fibonacci ratio, and that zone is called golden zone. Now if we are trading the supply zone and demand zone alone, there is a moderate winning probability, and if we are trading the Fibonacci zone alone, there's also a moderate winning probability. But if we combine these two, then we can increase the winning probability of our trading setup. Okay, and after that we went through how it looks like the trading psychology of why it behaves differently when we are trading them alone and when we are trading them in combination. Okay, so after that we went through an example and saw on the charts that how it performs, how when we combine the Fibonacci ratios and the demand zone and also a third key level, that is this swing high, then how it performed, because the price bounced from this level multiple times in the future. So this is how you can increase the probability of your trading setups.
What's up guys, I hope you're doing great, and today in this video I want to talk about the confluences that you can use with the supply and demand trading strategy in order to increase the winning probability of your trades. So before going to the confluences themselves, first we need to understand what does the confluence mean. And in order to do that, let's review the confluence definition. If we go over the definition, confluence is the combination of multiple strategies and ideas into one complete strategy. Confluence occurs when two or more separate ideas or strategies are used together to form a comprehensive investment strategy that is in line with the investor's risk profile and goals. So what this means is, let's say if you're trading on the basis of a single strategy, that strategy could be based on any analysis like RSI, MACD, candlestick patterns, or any analysis, but you're only taking into consideration one analysis. So let's say you're trading on the basis of RSI. Now, when you're trading with that, you will not be able to take a lot of good trades because RSI on itself does not work really well. So what you do is you take into the consideration the formation of candlestick patterns. So when you combine these two analyses, then the strategy that will come out will be much better than trading either candlestick patterns alone or the RSI alone. So this is how you combine multiple analysis and multiple strategies to form a single strategy. This was a very basic example. So here we can see a chart of few of the very good confluences that can be used along with each other or along with any analysis that you're doing. So first one is the Fibonacci tool, and second one is the candlestick patterns. So and then we have the support and resistance zones, the chart patterns, key levels, and supply and demand zones. So in this video, we are mainly going to be focusing on the supply and demand zones and key levels, or supply and demand zones and Fibonacci retracement tool. But in our upcoming videos, we will also be covering the candlestick patterns, the support and resistance, and chart patterns, and how you can use each of these along with the supply and demand zone. So as I said, that in this video, we're going to be focusing on the supply and demand zones and these two confluences. Now, another thing you have to keep in mind while you're trading with confluences is you should not add a lot of confluences. Like, let's say if I am adding a confluence of candlestick patterns, and then there's also confluence of RSI, and then there's also a confluence of support and resistance. So a lot of confluences combined together will decrease the chances of you taking good trades, because then you will not be able to find trades that are within your specific rules of the analysis that you define. So that's why you should also take into consideration that your number of confluences should not be more than one or maximum two for an analysis. Okay, so let's say if I'm trading with supply and demand zones, let me just go towards the chart, and let's say if I am trading on the basis of supply and demand zones. Okay, now as I said, we're going to be focusing on the Fibonacci retracement and the key levels. So in this scene here on the chart, we can see that there is this very big bullish move in the market from here to here. Okay, and within this bullish move, there is the formation of this demand zone. Now when we take the Fibonacci retracement tool and draw the retracement for this bullish move, so the Fibonacci retracement tool, if you're not familiar, is a tool that is used to calculate the retracement levels for a big bullish moves. It could be either in the bullish direction or bearish direction. So let's say from here to here, market moved very impulsively. And if I take the Fibonacci retracement tool and draw it from this low to this high, then it would give me a 61.8 level to which the market might retrace. And most of the time it does follow that rule. So the zone between the 50% and 61.8% is the golden zone. And let me just take the Fibonacci retracement tool and start to draw from here to here. Okay, so here you can see that for this bullish move, when I draw the retracement, the level between 0.5 and 0.618, or 50% or 61.8%, is the golden zone. And within this zone, there is the formation of the demand zone. Now, what does demand zone say? Demand zone tells us that after the formation of demand zone, there will be a lot of pending buy orders placed by the institutions, and market will come back in order to pick the pending orders and then move in the bullish direction. Okay, and what does the retracement say, or what does the Fibonacci retracement tool say? It says that after this big bullish move, the market will retrace back towards this golden zone, and after that, it will move in the upward direction. So now both these analyses are complementing each other, and this is very important. So when these analyses are combined and both of them are giving similar analysis or similar forecast, then the probability of our trades winning increases by a lot of folds. So now, as you can see, after the formation of this big impulsive move, the market did come back and it did pick the pending orders from this demand zone, and also it retraced only to this golden zone, and after that it started to move in the bullish direction, as you can see here. So this is the power of using confluences with the supply and demand. By the way, you can also use our supply and demand indicator in order to draw the supply and demand zones automatically for you on the charts. And for now, we also have a 30% off Christmas offer going on, which is valid till the end of December. So if you're interested, please check the links in the description. Now let's talk about the other confluence that you can use along with the supply and demand zones. And that other confluence is the formation of key levels. Now, key level is any level that is important for price action. And if we look at this key level, first of all, let's look at this bullish move. Okay, and Here we can see that within this bullish move, there is the formation of this rally base rally demand zone. Now, with the formation of this demand zone, if we look in the past, we can see the formation of key levels, and there is this key level from which the market is being rejected multiple times, and also at this key level we can see that market got rejected a lot. So both these key levels are important because market is getting rejected from these key levels, and also at the same level in the market there is the formation of this demand zone. Now, when these two analyses are combined, again we get an output analysis that says that after the formation of this supply zone, and after, because these are important key levels, the price will behave when it reaches these key levels. So when we see that at this close of this candle, the demand zone was complete, and within the next candle the price came down to pick the pending orders, and then it moved very impulsively in the bullish direction. So this is how you can combine multiple analyses in order to form a single analysis.
Hey guys, welcome back. I hope you've been doing great and Happy New Year to you all. In our previous video, we talked about how you can use supply and demand zones and add a confluence of key levels or Fibonacci retracement tool in order to increase the winning probability of your supply and demand trading. Now in this video specifically, I want to focus on the SR flip level or support and resistance flip levels, and I'm going to show you how you can add the confluence of supply and demand zones and also the candlestick patterns in your SR flip level strategy in order to increase the winning probability of your SR flip levels. First of all, the thing that we need to understand is what are SR flip levels in Forex. Now, if you're already familiar with the support and resistance levels, the resistance level is any level from which the price gets rejected in the bearish direction. So let's say if the price is going upward and then it bounces back from here multiple times from this level, then this level will act as resistance because it is resisting the price and it is resisting it from going upward. So from here, this level is acting as a resistance level. Now, if the price comes down and gets bounced in the bullish direction from a certain level, that level will be called as a support level. As you can see here, from this level the market is getting rejected in the upward direction, so this will act as support level. Now, what are SR flip levels? As I just told you about the resistance and support levels, SR flip level is a level from which the market turns a resistance into support. So any level where our resistance turns into support or support turns into resistance, that level will be called as SR flip level. Now let's talk about how you can detect the SR flip levels, because it's a little bit different than detecting a simple resistance level or a simple support level. In order to detect the SR flip level, what you need to do is pay attention to the wicks of the candles. So if there are a lot of wicks at a certain level, then that means that that level is very important, because at that level price is not staying, and because the wicks or the shadows represent the price rejection from a certain level. So whenever there is the formation of wicks at a certain level, that means that the price is not staying at those levels and there is a lot of price action happening. So those levels will become our key level, and those levels will be called as SR flip level. As you can see here, from this level the market is getting rejected multiple times, and after that, with this bullish candle, this level breaks and this resistance turns into support. Now again, there is a lot of formation of these wicks at this level, so this level is now acting as a support, and after some time, with this big bearish candle, this support level turns into a resistance level again, and then here you can see again the formation of these big wicks or big shadows. So because of the formation of these rejections and these big shadows, we have understood that there is a lot of price action going on at this level. So this level will be a key level, and this level will be called as SR flip level. Now that you understand how you can detect the SR flip level, let's talk about how you can trade the SR flip level. So right now I am at 2 hours time frame at AUD CAD chart, and here you can see that after drawing this SR flip level, we can go towards lower time frames in order to trade this. So let's say if we go towards the 10-minute time frame, and since we have already drawn the level from this here, okay, so from here if we zoom in a little bit, we can see that at this level, since this level was drawn at 2-hour time frame, now we are at lower time frame. So after detecting this level, after detecting this SR flip level, we can go towards lower time frames to find any confluence that we can add. So in this case here, we can see the confluence of drop, base, drop, supply zone, and also this level is acting as a resistance for now. So now both the supply zone and the resistance is at the same level. So both of these complement each other, because the resistance psychology says that price, whenever the price comes back to this level, it will get rejected. And the supply zone psychology says that whenever there is a formation of supply zone, there will be a lot of big institutional orders, and those will be the short orders or sell orders. So whenever the price comes to this supply zone, the market will pick those pending orders and move impulsively in the bearish direction. So if I just go ahead and draw the supply zone, let me just go here, and if I draw the supply zone from this high to this low, and if I extend it, we can see that this supply zone and this resistance zone is forming at the same level. Now after the formation of this supply zone, the market comes back in order to pick the pending orders. As you can see here on this candle, the market picked the pending orders, and then it goes in the bullish direction, as we can see here. Okay, so with the addition of supply zone to this SR flip level, we were able to take a successful trade that shows us that after coming to this level, the price gets rejected in the bearish direction. By the way, you can also use our supply and demand indicator to automatically detect and show you the supply and demand zones on the charts. If you're interested, please check the links in the description, and the indicator also has an alert feature which will notify you in real time whenever there is the formation of a supply or demand zone on the chart. Now let's talk about how you can take trades using the SR flip levels. And if I go here, we can see that there is the formation of this inside bar candlestick pattern. As you can see, there is this candle, and then before that, this candle is totally engulfing this candle. So this is an inside bar candle, and inside bar candle represents the indecision phase in the market. So whenever there is formation of an inside bar, then buyers and sellers are kind of struggling to take control. But with the breakout of next candle, we can see that finally sellers were able to take control of the market, and after the formation of this big bearish candle, the sellers have the momentum at the end. So now what do we see here is that there's this SR flip level, and also at this same level we have the formation of inside bar. So if we trade this inside bar and take our trade from here, so let me just go ahead and take a short position. So if I put my stop loss here, my entry at the close here, close of this candle, so then we can see the market going in the bearish direction for a very, very long time, as you can see here. So with the combination of SR flip levels and this inside bar candlestick pattern, we were able to combine these two into one analysis and get a trade that worked out very well in our favor. So this is how you can combine multiple analyses in order to form a strategy that will be better than if you were trading that single analysis. For example, in our case here, we combined SR flip level with a supply zone and also SR flip level with a candlestick pattern. So I hope you were able to understand how the confluences work and how you can combine multiple analysis in order to form a very good trading strategy. If you have any questions, please comment down below and I would love to answer them. Also, don't forget to like, share and subscribe. See you guys in the next video. Thank you.